And joining us now is Larry Summers, former Treasury Secretary, of course, to President Clinton, former director of the National Economic Council in the Obama administration. Larry, thanks very much for being with us. What would you have done in this situation?
I think the authorities got it about right, given the magnitude of the problems that were being faced. There was an absolute need to restore confidence, both to protect against runs against many, many banks across the country and to assure that people could get their payroll checks, businesses could continue to function in Silicon Valley. So I think the broad approach that was taken to close SVB while supporting its depositors and to make available support to the banking system more broadly, I think that was the right approach, and I think it will insulate the economy from the largest part of all of this. I think there are all kinds of questions that need to be looked at. Management, as best I can judge, was pretty irresponsible about managing risks. I don't really understand how that could have escaped the attention of supervisors. I think there are a set of questions about the way we do bank accounting and bank monitoring when the value of their assets fluctuate that are going to need to be looked at very carefully in the future and that bear on many different institutions. I think stress testing, which is what we do to kind of make sure that banks are safe, is still a very imperfect science, and we keep being surprised by the stresses that the real world turns up, and we've got to do a lot more about that. And very fundamentally, Andrea, we have to face the fact that what we've just seen is that a bank that was not a mega bank, the 16th largest bank in the country with less than 1% of the country's banking assets, when it faced failure, it was necessary for the whole system, albeit with taxes on other banks, to step forward and provide a broad rescue. And if that's true, what that says is that we can't rely on market discipline because there's always going to need to be a rescue. And that speaks to the need for much stronger regulation. And I think the steps that were taken in the legislation that was referred to earlier, but also a range of specific steps that were taken at the Federal Reserve System and in the regulatory agencies during the Trump years were very problematic. And I think there's a lot that can be done without new legislation, simply with proper recognition by the relevant regulatory authorities going forward to keep banks safer, to subject them to more rigorous stress testing, to not look at appraised values of things, but to look at actual what they're selling for in deciding the health of banks.
There's a lot to unpack there. So let me go to your last point, that regulators, the Federal Reserve, the FDIC, can do more without legislation. They don't have to worry about trying to get the Dodd-Frank reinstated if they can't get it through both houses, but that they can take a much closer look at the way they appraise and how they stress test, and should have been.
I think that's absolutely right. I'm very optimistic that Michael Barr, who was recently came into the position of being the vice chair of supervision of the Fed, who has a lot of experience. He was involved in authoring Dodd-Frank from a perch in the Treasury Department. He worked with me back in the Clinton administration in the Treasury Department, and he's been studying these matters for the last 20 years. I think he has a major opportunity and a major obligation to really provide leadership to the entire regulatory system, because what's happened here raises very fundamental issues about how we judge an institution to be in good standing and how much testing we subject institutions to. And I think there's no question that we all have a stake in the banking system. But after what we have just seen, where basically the U.S. government has signaled to all the depositors, large and small, in all the banks, that their deposits are going to be safe, that's a sign that we can't rely on market discipline now. We're going to have to rely much more on regulatory discipline, and that places real responsibilities on the regulators.
One quick question. Goldman Sachs economist is already saying that this means that the Fed can't raise rates again because higher interest rates were the cause of the problem. Should the Fed pull back on its inflation fight?
This is one of those weeks where we're going to learn a lot, and the Fed doesn't have to make that decision for another week. I certainly hope that this is not going to change monetary policy from the non-inflationary path that it needs to be on. This may mean some tightening of credit conditions, sort of like tighter monetary policy generates, and it's obviously appropriate for the Fed to take account of that. But if we were to slack off with respect to inflation because of these shocks, I think we would be making a serious mistake that would be leading to larger problems down the road.